Well, hello members and welcome to the weekly wrap. Here it's July 3rd. It's the afternoon, actually almost evening when I'm finally getting around to this. Had a great day off. Hope you're doing the same. As far as what happened last week, big move back up, right back the other way, much stronger than I expected, probably most people. Three and a third basically across the board, Russell 2.6. So markets just recover everything they lost on the Brexit and act as if nothing really happened. Today I'm gonna actually do something a little different than I usually do, and that is I'm gonna pull this back. I'm gonna talk about kind of a much larger picture here, and what I'm seeing with respect to that. And to say that the markets behave rationally the past couple of weeks probably is a stretch. Huge higher, huge run higher into it, collapse, and then a straight back spike up, right? One of the things that we try to do most of the time here is we try to just kind of forget about why things happen and try to focus on what is happening and where's the best probability setups ahead of us. And so if we, think about it from this perspective, what is moving and how is it moving is really the question. And if we use that, we can actually try to talk to the whole question of, what's going on bigger picture and what's probably going to take place. And since the sectors really get moved by the markets and the stocks get moved by the sectors, you always see me focusing on the general markets, right? And the sectors for the direction of what's going to take place. And that implies that we're constantly going to focus on these things, but not just that. We're going to do that on equities, and we're going to do that on the mature markets like Europe, Asia, and the US. That's what you see me looking at all the time. But you have to look at the other things like bonds, like commodities, like currencies, right? All these things move in tandem. They move each other. They make things happen. So that's a focus that we have to have. So what are these things telling us, right? That's the question. If I look at the US indexes, right? S&P trades right back up to that key level. And so if I bring it up, bring the chart over, pull the weekly over, show you that, right? Here's the weekly chart, and what does it do? Comes right back to this 2103 number. We're sitting right there again, right? And where does it close? Right at it, 2102.95. That's the key spot. I've talked about it several times. I kind of thought we'd given up the ghost last week and we weren't going to see it, and we were going to push back up, but we wouldn't get back to these levels. Well, turns out it comes right back to the level, right? Just like it has before. It's going to test it again, right? Going to try to get over it. And so the equities here in the US, they're right back at the highs, trying to break over the highs again, trying to get right back up to new highs. That really wasn't what I expected, probably wasn't what most expected. If we look at the NASDAQ, right, what does the NASDAQ do? It comes right back to the top of the breakdown bar it was playing with. And so if we look at it, right, the breakdown bar that was of interest there, if we put it on the weekly, was this bar, right? It's the same bar. Let me get this drawn. It's the same bar that we've been looking at before. If I get a box here, I can show it to you. It's this guy, right? That's where we've tested before. Here we come. Going to test again. If you look at the NDX, right, it's the same story there as well. And so we're seeing the same thing over and over on all these markets, right? They're coming back to key levels, going to try to get back over those key levels. This is the one on the NDX. So as they push back up, they're there to test again, right? Still hasn't changed anything. So we take a big dip down, big dip back up, or a big spike back up, and we're right back to where we started. Now, if you look at the world equities, it's a lot different, right? Long-term bearishness across the world equities, and it doesn't matter which ones you look at, it's pretty much the same across all the board. That's true in Asia, and it's almost true in Europe as well. On the weekly charts here, we're bearish. And on the monthly charts, we've tested down towards those swing point lows. DAX being the strongest, of the group, or had been the strongest of the group. If I bring up the CACs, for example, let me grab that chart on a monthly basis, and here we can see the same sort of thing where we're coming down trying to test those lows. We look at it on a weekly; it's bearish there. Now over in Asia, it's bearish everywhere. I mean, I'll pull up Hong Kong, for example, and we can look at that one. Hong Kong, bearish already, wanting to go deeper, right? They've already tested under swing point lows, broke down here, got to bounce up, doing a retest regen, probably going to try to test deeper. If I look at almost any of the markets in Asia, they look the same. So we have intermediate term bearishness in Europe trying to break down on the long-term time frame, intermediate and long-term bearish on the Asian markets. So equities in general outside the US market, they're long-term bearish, or at least they're trying to get there, and it's certainly true in the frontier markets. If I look at commodities, right, gold and silver, they're confirming a flip around. They're trying to go bullish. Here's the GLD on the weekly. It's already gone bullish. If you pull it over on the monthly, it's already gone sideways. Got over the swing point high, going after the next one. And so we're seeing long-term turns looking like they're taking place in the precious metals. We're seeing breakdowns in most of the equity markets continuing to be pressured. We're seeing bonds go up like crazy. I mean, let me pull up the TLT here, show you a 30-year or 20-year in this case bond, and what we're seeing there is a breakout to the top side, right? We've eclipsed and set all-time record lows for yields, all-time highs on the bonds. This market has been in a bull market since 1980. We're talking 36 years of a bull market that just continues. You can't get yield anywhere. If you look at, whether you're looking at the bonds, if you're looking at corporate debt, for example, if we look at the high yield debt, it's not as good, but it's up here trying to break highs as well on a weekly. If you look at it on a monthly, about middle of the range. If you go down a grade and you look at junk bonds, much different, right? And so what does all of this tell us? You know, it's saying, hey, people are not interested in yields that carry more risk. They want the safety. That's why the bonds, the treasury notes and bills, that's where people are going. And they're going to it because they can't get it anywhere else in the world. So you've got equities weak, most of the world strong in the US. You've got commodities beginning to turn in terms of precious metals, but not in the general commodities. You have bonds, US bonds, high yield debt not so good, junk bonds not at all, and you have currencies. US dollar stronger. Almost all the other currencies are bearish or have been bearish longer term against the dollar. What does all that mean, right? When I try to put it all together and ask myself what does it mean, it just seems that judging from the junk bonds, there's a real fear, right? The economies of the world are going to suffer a recession, and you're going to see defaults on that high yield type debt. If you look at the quality of the debt, there simply isn't enough to go around. And so what you have is you have people paying up to get in the safety of US bonds. They can't get it anywhere else. They can't go to German bonds. They can't go to Swiss bonds. Swiss bonds are negative rates all the way out to the 50-year bonds. You can't get yield anywhere, so they're coming to the US to try and do it. And if you look at the precious metals, what is that saying? Hey, there's still danger out there. People, real or not, people perceive it, they expect it. They think the world equities are precarious. They think the world economies are precarious. And they want the safety of something as an alternative to these currencies that are currently getting devalued. These principles, it appears to me, have led investors to consider that the central banks, essentially, around the world, they have no choice but to continue to configure and fuel this debt growth. And that this has, in the past, caused equities to rise. And so if they're going to continue to push it, then equities could continue to go higher, but there's a lot of risk in it from the way people look at it. That's sending equities higher, it's sending bonds higher, it's also sending the precious metals higher. And so the key takeaway in my mind is, even though it's hard to imagine, right, this market could be in consolidation, not distribution. We could get another leg up. This pattern where, you know, the market did this and then has been doing this could simply be the move before the next move higher. If the bankers come out all guns blazing, start putting more liquidity into the markets, right, that liquidity is going to chase returns and it's going to push stock markets higher, bond markets higher, precious metals higher. And so that may be where we're going. And even though it's hard for me to believe that's going to take place, I realize that it can, and I have to be ready for it. And if we get those breaks of 2103, that's the precursor to potentially that taking place. So we have to be open to that possibility. On the flip side of it, we're still underneath that level. We're still consolidation, and we still could break down. It's an either or. We don't know which one it's going to be. We have to keep focused on these key levels and decide from that what's going to take place. If I look at most of the sectors, they're mostly still bearish. Nothing's happened there. They did some reversals, but they haven't changed their trends after going bearish. If I look at focus, right, it's earnings. Earnings are the next things in the central bankers. Bottom line, not only did the markets last week hold up, they held up even better than I expected, a lot better than I expected actually. And so the potential scenarios for this week is they just keep going. They just blow out the tops. I mean, that's possible. I don't think it's likely in front of earnings, but because of earnings, we're probably going to just hang up here. They're probably going to stay up here, and they're not going to come back down. I started to think maybe a better thing to do for everybody is to try to give the best ideas on a short-term basis and a longer-term kind of trade investment basis. On a short-term basis, you want to buy anything, right, that just took out last week's highs and didn't make lower lows on Monday. For example, IYR. Even though we did on this one get slightly lower, we more than took away what happened. Here's the slightly lower undercut, less volume, and then it just skyrockets back up. It doesn't mean you have to buy it right away, but these are the things you want to be in. Get any kind of retrace back into this area is probably a good buy. And so, IYR, anything that behaved this way is probably a good buy. Another thing on a longer term is England, right? If I go look at the FTSE, contrary to what probably most people would think, is the FTSE, after the big spike on Brexit and then a little bit of a retest on Monday, just soared, and it soared to new highs. It broke out. If you bring it on a weekly, you broke out on a weekly as well. This thing's soaring. Why? QE. Pure and simple. More liquidity. Putting money into the system to take advantage, or actually to ease the issues surrounding this quote-unquote Brexit worries. And so you're going to see the central bank step up, you're going to see the government step up, and you're going to see equities go higher as a result. Now, how can we take advantage of that? Well, we can't just buy the FTSE. Some folks can, but you can buy an equivalent of it. The thing that we want to do in the U.S., if you're in the U.S. or if you're in Australia or wherever you are and you're not in England, if you're in England, you just want to buy it. But if you're not there, you want to take care of the currency. There actually is a hedged ETF, DXPS. If we look at that one, here on the daily, you can see how it just totally surged to new highs. Now, it doesn't have a lot of volume. We're talking 12, 24K. So there's not a lot of volume. So this is not something you're going to trade. This is more of an investment. You get in it, you stay in it. Breaks out on the weekly as well. And the monthly looks pretty strong as well. So in a nutshell, as the market comes back up, again, much stronger than we expected, which was also the case previously, if you remember, as we were moving up back here. When the market's much stronger than expected, we really have to respect that, right? Something's at work that we don't see. And right now, something's at work. Whatever it is, it's there and it's at work. Can it get over this high immediately? Probably not. It's probably going to pull back. When it pulls back, what should you do? I think you look at those investment ideas that make sense. I just gave you a couple. I gave you an example with the IYR. There's others out there that are like that. You just have to search and find them. And the DXPS, all right, I think is a longer term investment ideal that we can look at, where we get currency neutral and take advantage of probably is what's going to be a multi-month run in the FTSE. That's it for today. Thanks for joining me. Have a great one. Have a great holiday weekend. 4th of July. Be safe. And I'll talk to you Tuesday. Good night.